This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the man, myth, the legend, Taylor from Life Goal Investments. How you doing, buddy?
None of those things are true, but I'm doing great, and thank you for having me.
Well, man, I appreciate you coming on the channel. You are my Wall Street guy. You're giving us a different look. I love the fact that we don't agree on a lot of things, which is awesome.
We just argued about inflation. Yeah.
Yeah, exactly. Hey, it's going higher. It goes lower. But something I do want to talk about, because I think we both look at this, is the consumer, right? It's been a study of mine for 30 plus years. We get an important number this Friday that I think is going to be ugly, ugly, ugly. And it is one of those numbers, and we'll talk about it in a minute, that sometimes is unimportant. I think it is going to be very important. And I'm talking about consumer sentiment. So let's talk about the consumer sentiment. We'll work in wealth effect, both positive and negative. But what do you think about consumer sentiment Friday? I have a sneaky feeling it's going to be a bloodbath, pretty ugly.
It is. It is. I mean, the consumer, I would just say, like,
video over.
Full on. It's yeah, shut it off. No, it's not going to be good. Listen, the consumer is dealing with inflation. Like, inflation is rampant right now. So, like, not to get off the consumer, but even to talk about small business. Small business survey just came out. The NFIB came out worse than it was in 2008.
Think about that.
Worse than it was in the great financial recession.
Yeah.
It's like, and sometimes you scratch your back of your head and you're like, who are they asking this stuff?
Yeah, exactly.
But who says this is worse than 2008 when the cover of the Wall Street Journal says that the United States is going to break apart? Like that, we're not there. But inflation is so meaningful to people and small businesses that they feel it to the core. And they get that billboard that they drive by every day with gas prices saying, $7 in Southern California. What?
Yeah.
Like, these are numbers we haven't seen ever before. So it's a scary proposition. I don't think the consumer can come out of this and say, I'm feeling good right now.
Yeah. I mean, when I look at the consumer, I mean, just everything is bad, right? I mean, not only the stock market, which is really, the wealth effect is real. People don't realize the wealth effect is real. The last 2 years, we've had a pandemic, sure, but people felt wealthy, right? There was a moment in time where the stock went down and the Fed just rained money on everybody. We paid people 75 grand a year to stay home. People had money to spend.
Stimmy checks for the employed.
Oh man, it was crazy. So again, we're just not there. And then we have other headlines that just got it. Like, even if you don't have a baby, to think about the formula shortage we've had, that's been all over the news the last 3 or 4 weeks. It's horrible. I just couldn't imagine. And then we have war, and then we have this, and then we have that. I mean, the consumer is, I think they've reached their breaking point. And then we have true trade down, right? People cancel. It's just, I think this is the month where the sentiment comes out, and it's just like they threw in the kitchen sink. They're done.
It's interesting. Last week, you can look at the two biggest retail. So Walmart is, I don't know I think Target's second, but anyway, if it's not the two biggest, it's two of the top 3 or 4 biggest consumer companies there are. Both of them get murdered on their earnings. And they both say that Target didn't overtly say it. Walmart did say the consumer is changing. And what Walmart said was they're now going from buying bicycles like they were during the pandemic because they had all of this flush cash sitting in their pocket, to buying the low grade Walmart brand of whatever it is, grocery that they need to buy. Yeah. That is a huge, huge negative forecasting agent. And Target said the same thing, but they continued to say, and we discussed this on our last topic, they continued to say that the consumer was strong. And it was very confusing because none of the data said that the consumer was strong, but they said that, and their profit margins got squeezed. If your profit margins got squeezed, it's one of two things happening. You're stocking the shelves with the wrong stuff, which isn't good because it's going to cause inventory buildup, which that's not good from a business perspective. But 2 is your input costs are too high and you can't pass them through to the consumer. If you can't pass them through the consumer, that means the consumer's not strong enough to withstand the inflationary prices that you're putting in front of them. And trust me, if the consumer was strong enough, they would pass them through.
Yeah, it's interesting on that one. I think Target and Walmart, executives overtly made the choice not to pass expenses and to eat some margin. I think they were shocked at how much margin they gave up. So I'm suspecting that you are not going to see margin compression next quarter. They are already raising prices and probably have already.
I was going to say, so what does that mean? That means prices going up.
And inflation is still going up. Yes, I agree.
And yeah, so wait, hold on.
Go watch video one.
I disagree on that for the record, but nonetheless, what I'm saying there is that they're going to pass through prices and people aren't going to be able to buy them.
No, then they trade down. Absolutely right. Yeah,
right.
That is again. I'm old enough to remember the 70s. You are not.
Correct.
Obviously. I remember the late 70s going to, I think it was Pack and Save, which was the cheap grocery store of the day. And we were down selecting ramen noodles. Right.
Ouch.
So I remember making those choices. And that's where a lot of families are today, right? We're not talking about discretionary, which bike I'm going to buy because I got $1,000 in the mail from the government. It's like, well, we got to eat. What is I remember it was 19 cents. I have no idea why an 8-year-old would remember the cost of ramen noodles, but a packet costs 19 cents.
Well, that point right there, though, is important. What you just made. People remember things that are kind of pivotal points, right? So this will affect people's spending, or not just now, yes, but for years, for generations. Look at the people like my grandparents were, Great Depression era people. Mm-hmm. They actually very modest jobs, all the above. They died rich people because they could not spend that money.
Yeah, they just
right. So like that sticks with you for years and years to come. So this consumer behavior, when those decisions are made, those are impactful on emotion and on psychology and on how people react for the rest of their lives.
Yeah. And that's where we're at, right? I think a lot of investors, if you've been doing this for 10 or 12 years, you haven't known a bear market. Right. You had a little whipsaw of a recession when we shut the economy down, which I hope we never do again. But you really haven't seen a bear market, right? I've invested through a couple of them. And I think there's a lot of people that want to believe that the Fed put still exists. They want to believe that buy the dip works. And I unfortunately know that the average bear market is 17 and a half months. And we're 6 months into this. Right. There's hope that so many people talk about a bottom, and bottoms are ugly. There's usually this huge capitulation because somebody goes bust. Right. The fact that the VIX traded just north of 30 and didn't peak in the high 30s or haven't been hit 40 as we were losing 1,000 points in the Dow tells you we're not near a bottom in my opinion.
No capitulation yet.
No, not even close.
What's interesting is that people are being very Pollyannish about this whole thing. When you look at social media, especially, they talk a lot about, stay the course. And I'm not saying that it's not the right thing to do, but they also are depicting the fact that there isn't more potential real downside to come. And I think that's scary because they talk about investing as 30 years out, it goes up at an 8% CAGR in a stair step. And it's not a straight line between the start and the finish. And it's something that they convince people to come into the market, which granted, investing over time does make money. I'm not saying that you should invest. That's how you build wealth in this country and around the world for that matter. But let's not make it sound like this is a stair step, upwards. Right now, we have not entered into a bear market. Once you enter the bear market, the average takes from the time of entering 258 days till you hit the bottoming point.
Yeah,
that means we haven't gotten there yet. Once we do, 8 months later is when the bottom will start to be created. And what it is these things die oftentimes of old age. And what I mean by that is people just sit around and go, okay, it's going to come around. 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 And then one exogenous event like you just talked about there takes place and they go,
I'm out. It's rigged. It's rigged. No, I don't know the rules.
Yep.
I'm gone.
Yep. It's exactly right. And it capitulates and it hits the bottom and it bounces out of the other side.
Yeah.
On this, the scariest statistic that I've seen, that's just a recent one, so it's fresh, is not only the length of the time that a bear market lasts or the drawdown that you see, it's where we are right now from a valuation perspective.
Tell me.
So valuations, stocks came into this very, very frothy. And when you talk about price to earnings, it matters whether you're looking forward or in the rearview mirror, et cetera. This is forward-looking price to earnings as of last week.
Oh,
Forward-looking price to earnings ratios are 18 times. So they've seen massive compression from the beginning of the year.
yes.
So 18 times. 16 times is right around average.
Okay.
But the average at the bottom of a bear market is 12 times. So let's just see what that means. Like,
yeah.
Go ahead.
Yeah. So this is exactly why I believe we haven't seen the bottom of the pain, because the first thing to go is compression, right? We by my research, we went from 26 to 18, right? Which is a lot, but it's
That's
not done.
meaningful, no doubt.
It's
right.
But it ain't over. And oh, by the way, we haven't even had the earnings season yet where people cut earnings. We had 95% of the S&P 500 report. 77% of them have beat earnings.
Exactly.
We have a season of pre-announcements, negative pre-announcements, and earnings missing coming. We haven't had that yet.
Yeah. Well, and this does not happen very often. This does not happen very often at all. When you see two things simultaneously playing out, multiple compression and earnings compression. Those two things, listen, like, make no bones about it. Here's exactly, boil down the economy, boil down everything that's going on. Here's what's going on right now. One, the economy is still strong. I'll say that. The economy is slowing. So we're coming off of a strong economy that's slowing. The second point, or the third point of that is inflation is high. And the fourth point is the Fed is raising rates to track down inflation. And how bad does that affect the first 2 points of where the economy is? There's no secret, and no one knows the answer to that question. It's how much does the Fed upset earnings to track down inflation? That's the game that we're all in right now.
Well, I got to throw one more variable in there. We'll wrap this up because we're going to talk about bear markets in video 3. The other thing that's going to happen is the Fed's walking a very fine line because they're clearly raising rates. And at some point that is going to affect unemployment. Where is right? Because that is their dual mandate: stable prices, full employment.
What is the most lagging indicator there is?
Yes.
Unemployment. Unemployment unemployment sees its lowest level
at the
when
beginning.
The market's rolling over.
Yeah. And well, also at the beginning of a recession, if you go back and look at the charts. So
correct.
Yep.
Yes. That's what I meant. The economic cycle is rolling over, not the market. The market foresees it coming, the leading indicator. The recession starts and you see unemployment at its thinnest point.
And it's so fun to talk about this stuff. Taylor, where can people find you? We're going to talk about a bear market in number 3.
Yeah, find us at Life Goal Investments on Instagram. We put out daily content there. So at Life Goal Investments on Instagram.
Thanks, buddy. Appreciate you.
You're the man.